So it's day two of the market falling dramatically. So we're down 1,700 points or so from the previous high, I guess. So we came back a little bit. Dow is only down 110 right now. So yeah, these things happen. We know that markets are volatile. We are seeing one thing that I think is new that I haven't seen in previous market moves that I can remember, at least. So here we go. Trump is blaming the market rout on the Fed and saying, Powell is being too aggressive and raising rates too quickly. So whether or not that is accurate, I think calling calling these moves in interest rates aggressive from the Fed side, I think is a little bit ridiculous. But this is the first time I can remember, at least, anybody publicly blaming the Fed and manipulating interest rates as affecting the stock market. And I think this is actually kind of critical in that, making the public aware that, basically at least a large part of the stock market moves and bonds and everything else in the financial world is heavily affected by what the Fed does. And, those few people, board of governors affecting the economy, wide. So from that perspective, I think it's kind of an interesting watershed moment. Since 2008, the Fed has taken a much larger public role as far as, how it operates. And, back in those days, you had Ron Paul in the Congress and, trying to grill Bernanke. And then we started seeing the Fed holding press conferences for the first time ever. So I think this is another step in that development of people becoming more and more aware. So really interesting stuff. And personally, I think we are we're right at the top. We're seeing interest rates move more and more dramatically as the Fed rate comes up, and then we approach whatever that natural rate of interest is in the current market, and we go beyond that, then things will roll over and crash. And I've mentioned this many times. Anything that's interest rate sensitive, like well, let's see. We've got real estate. That's always a big one. We've got car lending, which is rolling over. We've got student loans, credit cards, bond funds, because as interest rates go up, bond prices go down. So if you're in a bond fund, the total value goes down. If you're just going to hold a bond, an individual bond, and you're happy with the interest rate, you're happy with the coupon that you're getting, then great, no problem. And then, we're seeing some, secondary and tertiary effects in the stock market itself because, a lot of these large financial houses are, borrowing and doing carry trades and whatnot, whether they're domestic or international. So, a lot of our economic asset valuations are very closely related to the interest rates. And, of course, the Fed sets the base rate and then the market reacts to that. So, interesting stuff, Trump is so, erratic is one word, but, it's not like he has guiding principles that, then dictates a course of action. It's kind of like, grab bag of, this sounds good, I want to do that, and whatever. So it's ad hoc. So, it would not even surprise me for, if let's say the market rolls over and crashes and we go into a bear market, and people are going to blame Trump because it's on his watch, and Trump is not going to want to take that, so it'll blame the Fed. It would not surprise me for him to say that him to pull like channeling the spirit of Andrew Jackson and in wanting to end the Fed. I'm not saying that will happen, but I could see that happening, and it would be really entertaining if that happened. So keep your eyes peeled.